This chart does look familiar, doesn't it? Well, you're looking at step index on a 15 minutes time frame. And today it is the 22nd of July. It is day 2 of our contrarian trade model. Hence why I have dropped this video on YouTube at this particular time of the month. Around this particular time of the month, I am looking for reversals. I am bullish. I don't look for selling opportunities. No, I don't do that. I look for a bullish bias. Now on day 1, which was the 21st, which was yesterday, I was outlining the trade setup. I was highlighting the framework that I usually look for around this specific time of the month. Now, if you don't understand what the framework is, you can look at last year's commentary. I did explain everything, right? From the entry to the target, I explained everything. It's all in last year's commentary. So today is day 2, right? The 22nd of July. And the reason why I'm making this video, I like what I see on the 15 minutes time frame as opposed to the 1 minute time frame, which I was showing you yesterday with the consolidation here. Now, the setup that you're looking at is relative to the time frame that you're looking at. So this is the very same framework that I was explaining yesterday, but on a bigger time frame, the 15 minutes time frame, right? So we have the relative equal highs here, right? Step index had this consolidation yesterday and it rallied after taking out the sell side liquidity, the initial low of the day, right? We swept that initial low of the day and we rallied to the upside to print relative equal highs. Now, because of these relative equal highs, I am convinced that we are now going to the upside. When I start to see that step index is printing relative equal highs, it's baiting people to look at these relative equal highs and go short. That's what a lot of people are associating what this chart looks like. Well, I'm not seeing a shorting opportunity at 7,690. I am not looking for shorting opportunities. As I said, around this time, I am contrarian. I go against what the trend has been. It's really that simple. If you want to trade step index and really master step index, just come out around the 20th and look for the signatures that I was talking about on day 1, which was yesterday. So yesterday I talked about the market phases, right? I spoke about this consolidation, which is the very first phase of the market. Market makers know what they are doing when they print this consolidation, right? That's the start of every trend. It starts with a consolidation. So they allow the marketplace to build interest either on the buy side or the sell side. So in here, what we see is a range. So our range high and down here is our range low. So price action took out the range low. It did it in a shallow base. It just swept it and then went up to print the relative equal highs that you're seeing here. And by the way, this horizontal line is anchored to Monday's PM session, 2:00 hour. Now I have my time zone set to New York, always in New York. So this high is Monday's PM session. So when the Tuesday's price action began, it printed these relative equal highs here, along with the PM session of Monday. So we have an interest in going higher. That's what I like. Anytime I see relative equal highs around this particular time, the 20th, man, that's why I am producing this video. All right. So the market phases. What about the market phases, brother? What can you teach us about the market phases? Well, we have number one, the consolidation. So as I said, the market makers allow for interest to build either on the buy side or the sell side. How they usually play the contrarian trade setup is that they usually attack the sell side first. So in here, it's a bit interesting as to how they are doing it, right? They have went up first to print the relative equal highs, and then they dropped it lower. So if other individuals, like most retail traders, who would look at this and say that, hey man, the market has printed the resistance up here, and they have shorted the marketplace, right? Retail traders see that and they go bearish, and they are in profit all the way down into this particular low. So when they see this particular low being broken below, what are they doing? They get overconfident. All right? They get overconfident and they open more shorting positions because they're seeing this low being broken below and being treated as a resistance. Well, they are not wrong in thinking like that, right? They are not wrong. I totally started trading support and resistance just like that. Breakouts, break and retest, that type of stuff. It never works out because we are missing the mark. You are missing the mark. Price is telling you a story and you're looking at highs and lows in terms of a support and resistance. That's not the whole story, man. I keep on saying that's not a whole story, right? What is price telling you when it leaves these relative equal highs? We're going to come back to these relative equal highs at a later time. But now we need to drop down first and trick everybody into going short. A lot of people are going short. If you have not shorted the market with those relative equal highs there, when price breaks this particular low, what are you seeing? You're seeing a market structure shift going bearish, right? So when it comes back to treat that level, which was a support, now turn into resistance, right? You're wrong, buddy. The market has tricked you here. You're in profit for just a little bit of time, and then whoop, here comes the 6 a.m. 6 a.m., what is that? New York opening session. New York opening session, since it has opened, price action has been bullish. It has been bullish. So after 6 a.m. opens, you're looking for a fair value gap. Sometimes the fair value gap can occur at the 6 a.m. New York session open. But here we have a market structure shift. You can clearly see that we have a market structure shift. Price action prints this huge bullish candlestick closing above these highs down here. And it leaves this fair value gap. That is your fair value gap that you need to trade. So I'm going to highlight the very same fair value gap right here. From the low to that particular candlestick right there. So that is our fair value gap on the 15 minutes time frame. It is timed based, good people. It is a New York inefficiency. So let's see what this inefficiency has for us. Okay, let me just zoom in to make sure that I have drawn the fair value gap in the correct place. By the way, I am in the Rev trading view. So the candlestick might be a little bit different. I don't know, my derivative implementation chart is acting up. It doesn't want to load, right? So hence why I'm here in trading view. So the candlesticks might be different, okay? Just hold on, okay? Just hold on. I'm trying to teach you something here. So we have the 6 a.m. opening, right? It opens right here. We have the 5 a.m. 5 a.m. is the London session. London session lunch. Here it is. It has this huge wick. This huge wick, what do I teach about wicks? I teach that wicks are inefficiencies. So this wick has not been traded back to. It has never been traded back to. I like that. I love it. So the very first confluence that we are going up is this significant swing low. It has this candlestick in the middle, a higher low on the left, and a higher low on the right. So this makes the significant swing low. It's a wick. It has never been traded back to. So we treat this particular wick as some kind of like a breakaway gap. It has never been traded back to, right? So price action creates this particular swing low again, right? This particular swing low around the 7 a.m. And we know 7 a.m. is associated with what? The 7 a.m. opening range. So we have this inefficiency being printed, creates a market structure shift, has this displacement going to the upside, creating a market structure shift. Now the inefficiency can also be treated as a breakaway gap, because the 50%, as you can see, the 50% here has never been traded back to in terms of a candlestick body. Yes, we did trade inside of it, touched the 50%, but we never left a candlestick body. What does that tell you? Order flow. Order flow is bullish. So number one is the wick in London. London lunch has left this wick untouched. Number two is the respect of this New York fair value gap, consequent enrichment. We have not touched the consequent enrichment in terms of candlestick bodies. We don't leave a candlestick body in the lower quadrant. Below the 50% is the lower quadrant, and above the 50% is the upper quadrant. So we have a wick in the upper quadrant. We don't have a candlestick body inside of the fair value gap. It is order flow. It is bullish, right? The next candlestick here, it has an inefficiency as well. I love the breakaway right here. It's breaking away from the consequent enrichment here, right? So we're going to change the color to gray, right? Just to see the difference between these two inefficiencies, right? So this one has never been traded back to. So that is a breakaway gap. True definition of a breakaway gap. A fair value gap that has not been traded back to. When you're bullish, you will like to see these scenarios occurring, right? So price action trades up. Now here's the mistake that I did upon discovering the contrarian trade setup. Well, I would look at this chart, right? And I would see that we have these inefficiencies here and these inefficiencies here. I would draw out these inefficiencies and extend them to the right. And I would try to sell short the market. Why would I try to sell short? Because the market has been bearish. All throughout July, the market has been bearish. So when it came to the 20th price action, I will look at some bearish structures as well, because we are taught that we should follow the trend, right? The trend is your friend. Well, around the 20th, the trend is not so friendly. It will take from your wallet, and ruthlessly so, especially if you don't have discipline. So I would always blow my accounts around the 20th. So upon discovering that it is really a reversal and you can swing trade it, you can day trade it, you can scalp it, whatever it is that you're interested in, you can trade it as long as you are bullish. The majority of the time, you have to be bullish. Ignore bearish setups. Okay? It's like looking at the market maker models, ICT market maker models. If you are familiar with that, then kudos to you. You are well versed into ICT trading concepts. If you're not aware, or if you're not well versed into ICT concepts, well, that's the very first concept that I'd learn if I was new. If I was a beginner, I would learn what are ICT market maker models. So around the 20th, if we are bullish, we would be looking into ICT market maker buy model. A buy model, we have taken out the key level down here, right? This is our significant key PD array. And this here is another key PD array. Both of these key PD arrays, they are liquidity pools. A liquidity pool is also a PD array. So we have these two key PD array, and one of them has been traded down here. We have traded into our key PD array, which is associated with this consolidation, right? So we have swept the sell side liquidity. We are now remaining with the buy side liquidity. ICT market efficiency paradigm. This is it right here. They accumulate those long positions below this old low, right? And they leave these key signatures. They can't hide these inefficiencies that are being left out open. It's really telling you that it wants to go higher. So the relative equal highs, I love to see those relative equal highs being violated aggressively to the upside, right? So enough about the 15 minutes time frame. Let's go into the daily time frame and see what we can derive from the daily time frame. Step index on a daily time frame, and this does seem familiar, right? On a daily time frame, it is the very same market maker model that you're seeing here. It was visible on the 15 minutes time frame, and now we have transposed the very same framework into the daily time frame. Nothing's changed. The only thing that has changed is the time frame, but the mechanism behind it is still the same, right? So we have taken out the sell side liquidity down here, which was the January 20th low. We have taken that handsomely, right? And I did mention that around the 20th, this is when you take profits. If you have shorted the market around the mid-month of July, you are in profit going down to attack the January low. Around the 20th, that's when you exit your trade position. Because if you don't exit your trade position, you're going to be met with a market that is retracing and going into the upside. Why does it do that? Well, the market maker is very smart. The market maker is very smart. He understands, or she, whoever it is that is controlling the market, whatever that entity is, they understand that somebody out there, if they were lucky, they have shorted price in the middle of the month of July, right? Maybe whoever has shorted the market has looked at this particular down candlestick and they associate that with a bearish breaker. If you don't know what a bearish breaker is, it's not my model. I don't trade that. I focus on fair value gaps. I know a lot of PD arrays and I'm well versed in all of those PD arrays, but the one that makes sense for me is the fair value gap, right? It's the easiest one. So hence why I'm teaching ICT concepts through fair value gaps. So we have taken out the sell-side liquidity. Whoever was in charge of the marketplace going downwards with it, or whoever has shorted the market maybe up here back in the mid-month of May, they added their position in June, the June mega trade, going all the way down, and then they have trailed their stop losses maybe back into the mid-month of July. All of those trailed stop losses are going to be a draw on liquidity after the 20th. So the market maker is smart. They know that they have trailed stop losses up here. So they need to retrace all the way up and maybe take out those individuals that have shorted the market. I'm not saying that the market is going to go up there. The only, low-hanging fruit that I see is the trailed stop losses that are associated with the mid-month of July. So yeah, my chart on the daily time frame does look different. As I said, this is trading view. It's not the derivative implementation chart that I normally use to teach. So it's very different. I know the candlesticks are a bit different, but what can I do, man? The derivative implementation charts is giving me a headache. So I have to make a plan because I have to keep the playlist going. This is my favorite model. I love it because it's the easiest model to trade. All I have to do is show up after the 20th. I look back at the mid-month. There's a high. What is associated with the high? It is trailed stop losses. So I'm going to try and attempt a swing trade, buying the market down here and taking profit above the mid-month. So that is my target. I have a bullish bias and learn how to anticipate the contrarian trade setup that tends to occur at a particular time of the month. And usually the most obvious low-hanging fruit is the mid-month. So until then, guys, I will see you in the next video.